All right. So I know a couple days in, we got a lot of stuff that we went through. So thanks for hanging in with there with me. We got one more day. Super excited, but want to make sure that we help answer any questions that you guys have over the last couple days in today's sessions. And then tomorrow, we're going to definitely go through a lot more content as well. But so first, before we get going, so we have about an hour for this session. So for those of you who were here for yesterday's VIP session, what do you guys prefer? Do you prefer us, you guys just throw your questions in the chat and as kind of like rapid fire? That way I can get to as many questions as possible. Or would you rather us kind of have people come up and answer questions as well that way? And obviously, we're not going to be able to get to as many questions that way, but just give me one or two in the chat. Want to chat? Chat is more concise. Okay, that's what I figured. Okay, if we can just we can totally do the just the chat because that way we get to as many questions here as possible. Okay, so what we'll do just throw your questions here in the chat, and then we'll go for an hour, try to get to as many questions as we can, and then again, like last time, if we don't get to your question, then we'll you can just shoot me an email, personallegacyinvestmentshow.com, and I will make sure to answer that later. Okay. Okay, let's throw your questions here in the chat, and we'll get to as many as we can before we hop off here. Okay, so Mimi, once we set up with a one-on-one coach for any of the plans, what happens if I feel the quality of coaching is lacking? Am I able to request a different coach? Also, if I don't have upfront capital for the STR concierge now, am I able to add that at a later time after I improve my cash flow? Yeah. So first of all, we have world-class coaches that we have that have done multiple deals. And so, if in the off chance that you don't like your current coach, then we can definitely, bring you on with someone else. So that's not a problem. But yeah, and then to answer your second question, if you're not the upfront capital for the STR concierge, that's something that you could definitely add on at a later time as well. Okay, so Salah, okay, will the STR market projected to be a viable income stream in the coming years if AI, other factors come into play for human jobs, etc.? Sorry if I missed this earlier. Yeah, I mean, I still think that short-term rentals will still be expected to be a viable income stream for sure, because that travel demand isn't going away. People keep wanting that flexibility and experiences, and AI and tech don't really reduce the need for these physical places to stay. The two things that matter more than tech, I would say, are the location, the fundamentals, and also the regulation and local rules. I will look at those first. Now, obviously, it's not guaranteed, but I think people are still going to want places to stay and travel. So I don't foresee that going away anywhere. Okay, what happens after year one or two with depreciation on short-term rental? So the depreciation doesn't just stop; it just kind of levels out over time. And so year one, sometimes year two, depreciation is going to be heavier, especially if you use that bonus. But after that, you can still depreciate the property year after year, but it's going to be on a straight line basis from there. Um, Okay, question here from Jimmy. I'm currently a W 2 employee and plan to begin consulting in tech after creating my LLC. If I do plan to do short-term rental, can I use the business credit I developed in that LLC to then pursue short-term rental? If so, what would that look like? What is the best strategy? Yeah, you can, but I would just make sure to keep it clean, right? So you can use the business credit from the consulting LLC to fund the short-term rental startup costs like the furniture, the setup, and the reserves. But the short-term rental itself should usually sit in a separate LLC with its own bank account and also the insurance. And honestly, the best strategy is to use the consulting LLC to build credit first, and then deploy that credit for launch costs, but not for the property purchase itself. Okay, so just make sure to keep the entity separate, and then document the intercompany loans if money moves between them. Question here from Brian. Let's get that here. Okay. Would you advise using equity in primary residence to use as a down payment to purchase a home for a short term rental? Yeah, I mean, it can make sense, but only if the numbers are strong. Okay. So you want to make sure that you run the numbers, that those numbers look strong beforehand. And you want to run, like we went over the worst case scenario, even if it can cash flow at a worst case scenario, then I think it could make sense, especially when you're using equity for your primary residence. Um, but yeah, I would just make sure that you run all the numbers there very closely before you do that. Ashley, what state would you open a 529 plan? I know you can pick your state even if you don't live there. So where would you choose the plan? I would probably just open the 529 in the home state first, because it offers a state tax deduction or even a credit. That's usually the best move. But if your state doesn't offer a tax benefit, then you could go based on low fees, good investment options, and also the flexibility. Katie, I'm still confused about the mega backdoor Roth. Is it basically just opening the same Roth type account over the limit for regular? No, so it's not the same thing as a regular Roth. So a mega backdoor Roth uses after tax contributions inside a 401k and not an IRA. So you put money in. So you put money in above the normal Roth or pre-tax limits, and then you can convert that money into a Roth. So if it only works if your employer's 401k allows for the after tax contributions, and they also allow for in plan Roth conversions or rollovers. So the regular backdoor Roth is the IRA strategy, and then the mega backdoor Roth is the 401k strategy, but with much higher limits. Good question. Alex, I'm 32, single, working three W-2 jobs from three separate employers, making that's a lot of jobs, making 170 to $250,000 annually. Credit's not great, low 600s, 10 to $15,000 in savings, getting slammed in taxes, and killing myself working 70 hours a week. I'm ready to jump all in, but what do I do first? Whatever the steps I will follow. Yeah. So the first thing is, I mean, first is the tax leak, right? Max the pre-tax accounts. You already have access to those. You already have access to, and then clean up the withholdings as well, especially when you have three W-2 jobs. That way, you're not shocked in April. Okay, so clean that up first. The second step, I would definitely work on your credit. Okay, so especially if you want to access to the different business lines of credit, the low 600s is not going to get you approved for a lot. So work on that. Whether it's the getting the utilization under control, stop with the new inquiries, pay down your revolving balances. That's going to be step number two, I would say. And then the third step is to simplify your income, right? I would honestly just take whatever of those W-2s that's burning you out and then just replace it with one W-2, or you can even layer on the short-term rental. So that way you have another business where you can unlock the business income and the tax write-offs that come with that. And then, get rid of one or two of the other W-2s. So that way it's not just added chaos. And then, yeah, I mean, those would be like the moves I would follow. So first, figure out your tax situation, the credit, simplify your income. And then once you start that business, things will unlock and change. Okay. Let's see here. I had a question here from Aldofo. Let me pull that up here. Okay, if I personally own a home that I want the LLC to purchase, when would be the most advantageous time to take out a HELOC? Before the LLC purchases it or while it's still in my personal name? And then the second question was, once LLC is established, do I need to add the holding and then the trust or trust first? So to answer your first question, I would take the HELOC while the property is still under your personal name, because that way it's easier, it's usually cheaper, and you'll get better terms. And then once the LLC owns it, then most banks won't give you HELOC. So I would take the HELOC while the property is in your personal name first. And then your second question is, I would set up the holding company first and then the trust. So the trust is going to own the holding company, and then the operating LLC is going to sit under the holding company. That's how I set it up. Rebecca, okay, how are people handling healthcare when leaving W-2 and are going to self-employment? I already have a HSA with a W-2 high deductible that I can carry forward. Yeah, I mean, it's for self-employed people, it's not great. And I'm speaking from personal experience. So if you go like the traditional route where you just get like health insurance, depending on like how big your family is and all that, it can be like $1,000 to $2,000 per month, if not more. I'm not affiliated with this company in any way. There is a company called Crowd Health. Let me see if that's the right. Yeah, so it's a Crowd Health. Let me actually share my screen, show you guys what this looks like. I'm sure some of you guys have probably heard of it. This is probably an option that me and my family are probably going to switch over to eventually. It's called Crowd Health. So this is it's kind of like a crowd, or like it's like one of those ministry Christian insurance places, but I've heard really good things about this. I have friends and family that have used this as well, and so it's like it's pretty cheap. So you can go on their site and look into this, but this is what I would recommend looking into. Join crowdhealth.com. Because yeah, health insurance, self-employed, if you just go the traditional route, can cost an arm and a leg for sure. Karen, can I own a short-term rental in an LLC inside a self-directed IRA and rent the property to my other LLC? No, so that's considered a prohibited transaction. So if a self-directed IRA owns a short-term rental, then you can't rent it to yourself, your LLC, or any entity that you control. That's just a self-dealing rule. And then a self-directed IRA property has to be completely arm's length away. So, personal use, your family can't use it. They have really strict rules about that. So just make sure that you follow that pretty strictly because it can completely blow that up. Anissa, can you assign ownership of existing investments to a Roth? Also, can you transfer an existing Roth or can you transfer an existing LLC to a Roth? So the answer to that question, no. So you can't assign existing investments to a Roth. The Roth conversions, they have to be cash and they can't be assets you already own. And then for your second question, you can't transfer an existing LLC into a Roth. That would again be a prohibited transaction if you own or control it. Jessica, I have a W-2 and a property with no structure or utilities in a desirable location in STR possible. Can you tell me how I can get started to fund the development of it? Yeah, so here's how I would think about it. So the first would be the land by itself is hard to finance because most banks won't land or lend on raw land without a plan. But the usual path is to just use personal leverage first, and then you can then transition to permanent financing later. So that means you can look into a HELOC, cash out refinance. You can look into savings to fund utilities, and then that initial build costs. And then once you have those plans and the permits and all the utilities going in, then you can look into a construction loan with a local bank. And that way it's going to be much easier to get the project rolling once it's like actually real. And then if the short-term rental numbers are strong and they make sense, then the end game is just to refinance it into a long-term loan after it's built and stabilized. So just to recap, I would first leverage your personal capital to start. You can also bring on partners if you want to do that. You can build and add the value, and then you can refinance once the income exists. I would say that's probably the cleanest path. Okay, Belinda, if you have an LLC, can you pay your children to work? If so, what is the max? As I know, dependents can make over $5,200. Yeah, so you can definitely pay your children if the work is real. There is no dollar cap on what you can pay them, but if you want to stay below the thresholds, right now in 2026, I believe it's $16,100 that you can pay them, where you can use that $16,100 to use that as a business deduction for your business, and then you don't have to report that income to the IRS, and that income that you don't have, that's not going to be taxed. So, but you don't want to just pay them the $16,100 just because that's the limit. You want to make sure that you can justify that just in case of an audit. Sandra, can a traditional IRA roll over into a solo IRA? No, so there isn't any such thing as a solo IRA as far as I'm aware. Well, you might be referring to the solo 401k. So a traditional IRA can be rolled into a solo 401k if the plan allows it and you're self-employed with no employees. But that's often done to clear the way for backdoor Roth contributions. So I'm assuming, Sandra, that you meant the solo 401k and not solo IRA. Is this program the same or different than your short-term rental program? Just including more financial help? Yeah, so let me actually just put that here on the screen for those that, because I see a few questions about that. So this is what the program is. You can see on the screen here. I'll just leave this up here just for those that, are interested or missed it from the last session. This program, so these two, obviously this program is going to just be the Legacy Wealth Blueprint. Path B and Path C are going to be with the short-term rental layered in, and then Path B will be the Ascension, and then also will help you with the done for you operations after you find a property. And then Path C is going to be the ownership, where we basically kind of take it off your hands. We do it for you, And then that's for the people that want to actually purchase the property. Okay, so we have a couple different options. Heidi and anyone else that haven't booked a call yet, you can book a call, talk to one of our wealth advisors, free call. Just ask them about the different scenarios, your situation, and then we can pick a path that makes the most sense for you. So that's how I do it, and that's why we have those free calls for you at managemoney101.com, is to just see what your situation is, and then we can help from there. Okay, Tanny, rules are constantly changing for STR. A lot of cities are allowing less and less of these types of investments. How do you feel about opportunities in this long term? Yeah, I mean, some rules are changing, and that's definitely real. And then some cities are tightening rules, but demand for flexible stays isn't going away. Okay. I've been in this industry for the last 5 years now, and obviously, like, things do change, but like what matters the most is the location fundamentals and the regulatory clarity before you go into it. And that's, again, something that me and my team will help you with. If you pick markets that are stable or welcome to STRs, then that income can be super strong and super strong long term. So no, I don't think short-term rentals are dead. If they were, I wouldn't be, still having my properties, and I still wouldn't be offering the program to help with that. You just have to be selective and plan for regulation as a part of the model. It's just like any other business model. There's always going to be risks and different things that you can't foresee, but as long as you mitigate those risks beforehand, then we can, limit a lot of that. Okay, Isabel, can you please review the depreciation versus appreciation topic for tax purposes when you buy a property? Yeah, so when you buy a property, the IRS treats depreciation and appreciation differently. Okay, so depreciation is just a paper expense. So you can get to deduct a portion of the property's value every year, even if the property is actually going up in value. And that what that's going to do is going to lower your taxable income. Now, appreciation is the economic gain, and that's not taxed until you sell. So you don't pay tax just because the property went up in value on paper. So you can have a property that's appreciating in real life while the depreciation is reducing your taxes each year. And that's why I love real estate, and that's why Path C makes a lot of sense for people that have the capital available, is because you get to take advantage of the tax code, you get to make cash flow from it, and then you also get to take advantage of their appreciation. Okay, Matthew, for bad debt, do you use money from tax reduction strategies to pay down, or 0% car transfer from starting business credit? I would say it depends on the debt. The high interest bad debt, yes, I definitely prioritize paying that down first because that's a guaranteed return. And then using the tax savings to clean that up can be really smart, because 0% card tools or 0% cards can be used as a tool, but only if you have a clear payoff plan before the promo ends. Otherwise, you're just gonna, you're just like robbing Peter to pay Paul, right? So the order that I would look at it is, I'll first kill the high interest debt first. You can use the 0% strategically, and then don't add any additional leverage until the cash flow is stable. All right, so here, let me find this question that I just saw. Okay, Laura, any strategy you'd suggest for eliminating private student loan debts? Yeah, so private student loans are about cash flow and interest, right? So some of the strategies that you can look into is, the first thing that a lot of people don't consider is that you can refinance to the lowest fixed rate that you can qualify for. So that's step number one. If you have a high rate, then you can look into refinancing it. You can also pay extra towards a principal. Don't just make the minimums if you want to pay it off faster. And then you can also use extra cash flow or bonuses to knock down the balances faster. And then if income is unstable, then I would prioritize the emergency fund first and then accelerate the payoff later. So it really just depends on where you're currently at. But yeah, that's the path that I would follow. Jesselyn, we own two long-term rental properties. We manage the tenant screening, property management. Can we create LLC as property management company and pay ourselves through the LLC? Yes, that's actually a great strategy. You can create a different property managed LLC, and then paying yourselves usually doesn't add a tax benefit, but you just be moving money from one pocket to another. Because the IRS looks at common ownership, so management fees paid to your own LLC are usually still going to be taxable to you, but they're not going to magically create new deductions. But where it can make sense is just the liability separation. You also get cleaner bookkeeping that way. And then if you plan to manage properties for others later, then it for sure can be a great strategy to separate those two. Okay, question here from Peter. For short-term rental for purchase, sorry, I just lost your question. Let me pull this back up here, Peter. My apologies. For short-term rental purchase, are there any markets that you would recommend or avoid due to poor location, regulatory issues, oversaturated market, or in general, just tough to meet good financial metrics? Yeah, so you definitely want to pick markets that have long-term sustainable history. So, I mean, I can give like some examples that have good history, and again, these are markets like it all depends on the property within the market as well. But like Orlando, we have Austin, Phoenix. I know some parts of Nashville can still make sense, but you can also look into emerging like secondary markets, right? So think like smaller lakes, mountain towns. Some less known destinations can make a killing there as well. But I would avoid like kind of like the bigger cities like New York, San Francisco, LA. A lot of those have restrictions anyway. I would look at the demand fundamentals first. Don't always go for like the big cities because those aren't always going to make the most sense. I personally like to look into, especially if I'm purchasing the property, I like to look into like the emerging secondary markets. So like those lakes, mountain towns, less known destinations, those can always be good. But me and my team, if you do join the programs, any one of the programs will obviously walk you through the different markets that we're seeing and that we like, and go from there. Maria, does all income from operating LLCs flow to the holding company? What does that do for profits and losses for each LLC from a tax standpoint? Can losses from one LLC offset profit from the other? Yeah, so if the holding company owns the LLC, the income flows up, but the taxes don't work the way that most people think. Okay, so each LLC still keeps its own books and then tracks its own profit or loss. Now, for taxes, everything passes through to the owners on the return. So if all the LLCs are owned by the same person or the same holding structure, then profits from one can offset losses from another. That's assuming there's no passive activity limits blocking that. But the holding company doesn't create a separate tax wall by itself. It's mainly for ownership and also for asset protection and also for the control, but it's not for isolating taxes. So yes, the losses can offset profits, but the key difference is to make sure is to have this right ownership and also the proper reporting with the holding company. Joy, could you please talk about the difference between a 529 and a UTMA as far as using it to buy properties or holding LLC? Yeah, so a 529 and a UTMA are very different, especially for real estate. A 529 is only for education. So you can't use it to buy property. You can't use it to invest in an LLC or do real estate deals. If you do that, then it's a non-qualified withdrawal, and it's going to trigger some taxes and penalties. A UTMA is the child's money outright. So it can invest into real estate or an LLC, but once the child reaches the age of majority, they get full control. So you can't take it back or redirect it. And so the trade-off is pretty straightforward. 529 gives the tax benefits, but has stricter uses. The UTMA gives the flexibility, but you lose control later. Good question, though. Okay, Dustin, kind of curious about exit strategy. I mentioned it earlier, but what is the mitigation for short-term rental? If the housing market crashes, bubble bursts, I believe this would result in a gold rush for properties for those prepared to buy, but properties owned may significantly depreciate. Yeah, I mean, so the thing that I would look at is to look at different exit strategies. Okay, so let's say in a worst case scenario, short-term rental market, softens wherever you are in your specific market. So that means I would look at it and make sure that it works either as a long-term rental. Okay. You can also see if that can work as a mid-term rental. So you can even look at traveling nurses, business professionals. That can be a pivot that I know a lot of people, will make. Obviously, the cash flow won't be as high, but that you can definitely pivot into those different models as well. And then also you can even look into using it as a personal house as well if absolute like worst case scenario happens. I mean, the biggest thing is that as long as the property can cover the debt and expenses as a long-term rental or a midterm rental, then I would say that, that's probably a good deal that you can do. But yeah, I mean, obviously we can talk about thousands of different scenarios of things going wrong. But we obviously will make sure that we hedge our risk by making sure we run conservative estimates, having multiple exit strategies, and then enough reserves to ride out any volatility that does come. Okay, Matt, can you transfer the traditional portion of a 401k, leaving as a Roth value intact, to a self-directed IRA? If so, is that usually a plan or platform like Fidelity specific inquiry? Yeah, so it's possible, but it depends on the plan. If your 401k allows for in-service rollovers or you've left the employer, then you can roll only the traditional portion into a traditional self-directed IRA and then leave the Roth portion intact. So you do that, whether you do that is plan specific. So it's not Fidelity specific per se. Fidelity just follows the plan rules. And so the first step is to make sure that you check your 401k plan document and not the platform itself. Katie, can your kids fund 529 from their payroll? Yeah, so they definitely can. There's no rule against it. But it usually doesn't make a lot of sense because the tax benefit of 529 is on the parent's state tax or is the parent's state tax side and not the child's, right? So kids usually don't get much benefit contributing themselves unless someone else is matching it or is a part of a bigger family strategy. Brian, I have had both W-2 and LLC 1099 income for many years. Would you recommend submitting uh, amended 1040 for past years to take advantage of QBI? How many years back, 2018, will this raise risk or trigger an audit? Yeah, usually no. If QBI was missed, you can amend, but only open years, right? So that's generally 3 years back from when the return was filed. You can't go back to 2018 unless the year is somehow still open, which is rare. And then amending doesn't automatically trigger an audit. It only raises the risk if the change is aggressive or unsupported. But before you amend, you need to confirm that you're actually eligible for QBI in those years. So look at your income limits, business type, and also your W-2 wage rules. So I would first just check your eligibility and then only amend if the benefit is meaningful. And don't just amend just because the QBI exists, right? Because you'd be opening yourself up for a bunch of headaches if there ever was an audit. So just make sure that it's like the benefit is going to be meaningful first. All right, Beyonce, does it still make sense to put kids on S corp with the payroll and other employees, or is there a workaround? Usually no, because paying kids through an S corp uses the big benefit, which is because you still owe payroll taxes, so it's often not worth it that way. If your goal is to be more tax efficient, then I would say the better setup is paying your kids through a sole proprietorship or even like a parent-owned single member LLC, where those wages to those minor children can avoid the FICA tax. And that has to be real business with real work. So just keep that in mind. But yeah, you can put them on S corp payroll, but it's rarely optimal. If you want the benefit, I say you would structure around it and not inside the S corp. Fidel, properties owned under your personal name, first, are there ways to take advantage of tax benefits without being an LLC? The second, would you recommend moving those properties to an LLC? Yeah, you get the tax benefits either way. So the depreciation, the expenses, all the losses apply whether the property is in your personal name or an LLC, because the IRS doesn't care about the activity. They care about the activity and not the entity, right? And then an LLC, it doesn't create new tax deductions. It's all about liability and protection, but it's not about taxes. I think that's where a lot of people get mixed up. And then whether you should move them depends on the risk as well. So if it's a low risk long term rental with good insurance already attached to it, then I do see people leave it in their personal name. But if it's a higher risk, like multiple properties or short term rentals, then an LLC can make sense. Okay, so taxes don't change. The only thing that really changes is the risk management. All right, Hilda, if married and husband is W-2, wife with S Corp, and husband also has a side hustle LLC, how should we structure it to be under a holding? So you don't combine everything just because you're married. The way I would do it, the wife's S Corp, I would say separate because that's her operating business. And then the husband's side hustle LLC can stay separate as well. And then his W-2 stays personal. If you want the holding company, then it usually sits above the operating LLCs and not the W-2. And then the holding company can own the husband's LLC and then any shared assets or future businesses from there. But you don't put the S Corp under a holding unless there's a clear reason for it, like asset protection or you're looking at a future sell. Some great questions. Chad, okay, what about short-term rental on your primary resident property? I have primary bedroom that has separate entrance that I could rent 50% of the year. The property is on 2.7 acres in San Diego, so I'm also thinking about adding a trailer and listing that as on short-term rental. I'm also looking at Harvest Host. Yeah, so that can work, but you just want to make sure that you're clean about it, right? So, because renting part of your primary residence is allowed if local zoning and the short-term rental rules permit it. But you have to also allocate any income and expenses based on the portion used and the time rented. And that portion is going to become the rental activity, and the rest is going to stay personal. So a trailer can also work if it's legally permitted. In San Diego, I mean, I don't know the exact rules there, but I think the biggest hurdle would be the zoning. So I would look into that. In terms of Harvest Host, I haven't really heard of that. But yeah, I would just check to see if it's viable, check the local rules first, and then just make sure that you separate the numbers properly, and then just don't assume that every setup is allowed. Janelle, with Path A, do you also get estate planning, and do your advisors also have experience with special needs trusts, estate planning? Yeah, so Path A will definitely walk through, what you're trying to accomplish from an estate planning perspective, and then kind of map out that. And then we also have our vetted referral network that we can hand off to you as well to get the actual setup done. All right, guys, I'm trying to knock this through. Okay, Rich, are there any modified plans or renewals? I signed up for your Ascension program back in fall 2024. I'm interested in the Wealth Blueprint and getting started again on my next property with renewed access to AirDNA and the other software sites. Yeah, Rich, so you can just book a call with someone on my team. You can give them that context as well. We do have new product options since you signed up back in fall of 2024. So yeah, you can just book a call with the advisor and then talk to them, and they can kind of walk you through the different options that we have now. Leia, if everything is automated, how do you achieve the 100 hours to get the short-term rental tax benefit? Yeah, so this is a really good question. So here's how I look at it. The first year you want the deduction, and I'm assuming this is for if you're purchasing the property to get the material participation. So the nice thing about the 100% bonus and the cost segregation is that you only need to qualify for the hours in the year that you want the tax deduction. And so as long as you are in the first year, because one property is easy to manage by yourself and it only takes a couple hours per week. I would say it really only makes sense to bring on a virtual assistant or automate it like that way, only once you have multiple properties. But the year that you want the deduction, just do the work yourself. It's not that hard to like set up all the automations. And then once you log all your hours, then you can take the deduction yourself there from that first year. And then for the second year, then you can start hiring your team to automate everything. So that way it's hands off for you. That's how you take the deduction, and then you basically get best of both worlds. You just kind of do the work yourself the first year, and then the second year is when you can automate everything. So that way, like the IRS doesn't require you to continue doing the work every single year to take advantage of the deduction. That's why I love it, because you just do it for the 1 year, and then the second year you can start passing it off to a property manager or a virtual assistant. Okay, Ashley, what qualifies as a short-term rental, and why are the taxes and preferencing those instead of long-term? Are there minimum stays needed to qualify as a short-term rental, percentage of occupancy, etc.? Also, can you get the same tax cuts if you own short-term rental abroad? So yeah, short-term rental is defined by the average stay, okay, not how you market it. So if the average guest stay is 7 days or less, then it's going to be treated as a short-term rental for tax purposes, and that's why it's different from long-term rentals. Because and the reason why I like the short-term rental model here is a few reasons. So the first, it can qualify as non-passive if you materially participate. So that means the losses and the depreciation can offset your W 2 income, which is huge. Okay. Because long term rentals usually cannot, unless you're a real estate professional. And to qualify for a real estate professional, like you literally have to spend over 750 hours per year running any sort of real estate business, so a contractor, property manager, etc. And especially if you have a W 2 or if you have a full time job, then it's nearly impossible to qualify for the real estate professional. Now, unless you have a spouse that's a stay at home mom or stay at home dad, they can qualify. And then if you, let's say you have a W 2 and they are stay at home mom, they qualify for a real estate professional, then you can use the long term rental depreciation to offset your W 2 income. But most people don't have that luxury. So that's why I like to go the short term rental model. And then also the cash flow for short term rentals is much higher, which is another reason why I like the short term rental model over the long term rental model. And then because you only need a handful of properties for short term rentals versus long term rentals, you'll need 10 to 20, 30, dozens and dozens of doors to make meaningful cash flow. And then for your short term rental tax cut question for short term rental abroad, yeah, you can still get depreciation and expense deductions, but the special short term rental tax treatment generally doesn't apply the same way. Foreign property rules are different. The depreciation is slower, and then offsetting your U.S. W-2 income is going to be much harder. So if you do want to go the short-term rental route, make sure I would just kind of stick with the U.S. if you're getting it primarily for the tax benefits. Okay, buying a short-term rental through a self-directed IRA, do you get the same tax cuts or no, because everything is ran through a retirement account for later? If you buy a short-term rental inside a self-directed IRA, you do not get the current tax deductions. You don't get the depreciation, no loss offsets, and there's no W-2 sheltering. Everything stays inside the retirement account. Okay. Amber, how do I log in and review the video recordings for the workbooks and add-ons bought with the VIP? Please and thank you. Yeah. So for the workbooks, you should already have those in your inbox. I believe my team sent them out already for the workbooks. And then for the video recordings, we're going to be sending those out after my editor gets to them. He usually doesn't work on the weekends. So we'll try to get to those by Monday, Tuesday at the very latest. Yeah. So yeah, for the VIP holders, so everyone here, we'll be sending out the recordings probably by Monday or Tuesday at the very latest once my editor gets to them. But the workbooks, you should have access to the workbooks already. And so check your inbox. And if you need any help, just shoot me an email, Preston at legacyinvestingshow.com right here, and we'll help you out. Okay, Matt, if you run a cost segregation study and pull down that 100%, what is the exposure in future years if and when the property is sold? Does that depreciation offset equity? Yes. So it comes back at sale, but not the way that people are scared about. Okay. So cost segregation front loads the depreciation that lowers the taxes now. And then when you sell it, the IRS looks at depreciation and recapture first. Okay. Now, if you do plan to sell in the future, I would just continue to defer that by using a 1031 exchange. And that way you can continue to defer those. So that way you're not getting hit with that depreciation recapture. Okay, with both W-2 and 1099 income filing Schedule C, if using QBI, does the income limit include the sum of W-2 and 1099, or is it just the 1099 income? It's based on the total taxable income and not just the 1099. So your W-2 and 1099 income are added together to determine whether you're over the QBI income threshold. And so the deduction itself is calculated on the business income, but the eligibility and the phase outs look at your entire return. So yes, W-2 income counts for the limit. Alyssa, okay, my husband has his own law practice LLC. I have a rental property that I will put under another LLC. Can these LLCs be under a holding LLC? And does the holding LLC need to be where you live? Yes, so they can be under a holding company. The holding LLC can both can own both operating LLCs, and so one for the law practice, one for the rental, and then each business is still going to run separately with its own books and bank accounts. The holding LLC, it doesn't need to be formed in the state where you live. It's often formed where it makes the most sense legally or administratively. Like I have my holding company in Wyoming. I know others have it in Nevada. Delaware is another good place as well. But operating LLCs, they still need to be registered in the states where they actually operate. So yes, the holding company works. And no, it doesn't have to be where you live. In fact, I recommend having the holding LLC in one of those favorable states like Wyoming, Delaware, Nevada, etc. Laurie, should I use a HELOC to pay off debt? It really just depends on, I mean, it really depends, right? So if the HELOC rate is meaningfully lower than the debt you're paying off and you have a clear payoff plan, then yes, it can make some sense. But what you're doing essentially is you're swapping expensive debt for cheaper debt. So, and then the risk here is if you're moving that debt onto your home, spending habits don't change, then it's going to backfire. So it only works if you have discipline and you have a clear plan for that. Okay, let's see here. Question here from Sandra. Can the LLC paying kids tax-free be a Schedule E passive rental LLC? Yeah, it can, but only in very limited situations. So if the rental is owned as a sole proprietorship or a single member LLC taxed as a sole proprietor, then you can pay your minor children for the work that they do. And then those wages can also avoid income tax up to the standard deduction, which is the $16,100 for this year. But FICA treatment can still be favorable in some cases as well. But once a rental is treated as a passive Schedule E activity with those partnerships, the multiple owners, or even the corporate structure, then it's just going to get way harder and often loses the benefit. You guys have done your homework and you guys were definitely listening. So appreciate the thoughtful questions. Let's keep answering them until we hop off here. Okay. So a question here from Chuck. I had some expenses that added up and moved into a HELOC loan, and I have about $70,000 available at the current available interest rate, 6.5%. Is there a way to leverage that to create a cash flow that would offset the monthly costs for the loan and interest? Yeah, again, going back to the debt question, it only can make sense if you're disciplined. So let's say at a HELOC, 6.5%, it needs to be deployed that clearly beats that cost and then cash flows quickly, right? So I would first look at income producing income first, and I wouldn't just bank on appreciation bets. So, I would think short-term rentals could be a good option here, a high confidence business investments. It really just want to make sure, first and foremost, I wouldn't look into speculative assets at all. I would just make sure that you go into a property, or usually it's a real estate investment that pays you the cash flow quickly. And then it's also higher than the amount that you're borrowing from the HELOC. Vawi, can you implement Plan C ownership out of an IRA? Sorry, I lost your second part of your question. Let me find this here. Can you implement Plan C ownership out of an IRA? I currently have a 401k. Can you talk a little bit about the strategy to make that happen? Yeah, so Plan C is the ownership, right? So one of the moves that you can do is a self-directed IRA, right? But you want to make sure, like usually, I mean, the Plan C ownership doesn't really make a lot of sense in a self-directed IRA because you're already taking advantage of the tax benefits with the cost segregation to offset your other income. And so I would honestly keep it clean unless you're looking to buy it specifically for your, like for retirement purposes. But in most cases, it usually just makes sense to just keep it outside the IRA and then use those depreciation to offset your other income. And then obviously, you take advantage of the cash flow and all the other stuff that comes with Path C here. Kenzie, how do I pay my kids with the S Corp to get the tax benefit? So generally you don't get the tax benefit paying kids through an S Corp. So because in an S Corp, kids are treated like any other employee. Okay. You still owe payroll taxes. So that main advantage is gone. So if the goal is the tax benefit, then the workaround is paying them a sole proprietor or a single member LLC owned by a parent for the work that they do. And that's where the minor children can avoid the FICA and income tax up to the standard deduction. So you can pay them from an S corp, but it's usually not worth it. But if you want the benefit, I'll just make sure that you structure it outside the S corp. Okay, D, I purchased a property October 2025 in LLC, just finished minor repairs. Since it's still vacant, can I use that to turn it into a short-term rental for 2026 write-off in Georgia? Yeah, so because the property was placed in service after it was a January 2025, you can treat it as a short-term rental for 2026. And if you actually put into short-term rental use and you meet the short-term rental rules, then yeah, you can definitely do that and qualify. Just make sure that the average stays under 7 days. And then you also do the material participation. So that way you can use those losses against your other income. Christine, have you had success in seasonal locations like beach towns? Yeah, just we got to make sure that you just run the numbers properly because seasonal markets can still work very well if the peak season cash flow carries through the slow months. You have to obviously price aggressively in the season. You have to keep fixed costs low, and then also you want to plan for reserves for off season. But as long as you run the numbers properly, any market can work. Even if there's a market where it's only busy like for 3 months out of the year, as long as the income during those 3 months makes sense for the entire year, then yeah, it can definitely work. Okay, Graham, what are the benefits of having a holding company in other states like Wyoming, Nevada, and how does this get set up? This would be for an online business. So the main benefit isn't necessarily taxes, it's for the simplicity and for the protection. So states like Wyoming or Nevada, they offer low fees, they offer really strong privacy, and they also offer easy administration. And that can really help for an online business with no physical location. But what it doesn't do, it doesn't just magically lower federal taxes. Okay. You still pay tax where you live and where the business operates. But I like to have the holding company. It's mainly for the liability protection. So that way, it has the holding company and then it owns the operating LLCs underneath it. So the benefit is just cleaner structure and asset protection, but it's not to avoid taxes necessarily. Adolfo, okay, what makes states favorable for the holding LLC? So I would say low cost, strong asset protection, and then just having simple rules. A favorable state usually has low annual fees. There's no state income tax on the LLC itself, and then there's also different benefits like strong charging order protection. There's minimal reporting requirements, and then you're also looking for the privacy and the easy administration. And again, Wyoming's popular for this. This is where I have mine, but it doesn't operate or override where you live or operate. So yeah, I just want to make sure that you pick a state that has those things where it has the low cost, strong asset protection, and has simple rules. Cottrell, please resend my workbook. Never got them. Yes, Cottrell, if you haven't gotten it, just shoot us an email, preston@legacyinvestingshow.com, and then we'll get that over to you. Ashley, is there a minimum age for a child before you can hire them? There's no minimum age set by the IRS. Children of any age can be hired if the work is real and also age appropriate and the pay is reasonable. You just got to make sure that it's legitimate, right? So, like a younger kid might do better with helping clean, helping file stuff. But like a more advanced kid, let's say if they're 16 years old, then they can do more admin stuff like like helping with bookkeeping, that kind of stuff. So it really just depends on the age. Just want to make sure that you do it based on like the age appropriateness, just so it doesn't cause any red flags. Barbara, would you suggest borrowing against 401k to implement Plan C, which is the ownership? Any risks to be mindful of? It really just depends on your risk tolerance, right? And that's what the call's for, is to just kind of walk through your situation. We'll, want to make sure that we run the numbers here beforehand to make sure that, this path does make sense for you. But yeah, I mean, again, this just comes down to personal risk tolerance. And then that's something that on the call with the wealth advisor, you can walk through just to see, if that scenario might make some sense. Okay, Lee, I have an S corp that owns 40% of a rental complex. The S corp is out of Georgia, and the properties are in South Carolina. Used to own properties in Georgia. Should we create a new S corp in South Carolina and transfer ownership, or is it just going to complicate things unnecessarily? Yeah, probably unnecessarily. It's probably unnecessary because if there's S corp already owns the 40% interest, then you don't need a new S corp just because the properties are in South Carolina, right? You can keep the existing S corp and just simply register it as a foreign entity in South Carolina if it's required, and then creating a new S corp and transferring ownership usually adds cost, complexity, and potential tax issues without adding a lot of benefit. Now, unless there is a partner change or sell coming up, or there's any like legal specific reason to South Carolina, I just keep it as is and just make sure that you're compliant with South Carolina registration and filings. But yeah, that's how I look at it. Okay, Alyssa, I'm currently a W-2 CEO for a consulting company. Should I move to creating my own LLC so that the company can pay me as an LLC instead of a W-2? I mean, usually no. If you're CEO doing core executive work, then that role is almost always supposed to be W-2. If you're switching to an LLC just to change how you're paid, might create some misclassification risk. But really only can make some sense if your role truly changes to an independent contractor. That means like you have multiple clients, your own tools, and you don't really have any employee style control. But for most executives, the right move is probably just to keep the W-2 for the stability and the benefits, and then build an LLC on the side if you want the flexibility. And this, would it make more sense to do an international STR out of Roth and then a US short-term rental from non-Roth money? Yeah, I mean, that generally can make some sense because international short-term rentals usually don't give you the same US tax advantages. So putting them in a Roth lets any growth be tax-free later. And then any US short-term rentals are better held outside of a Roth because you can use the depreciation and the losses now to offset the income. And so the Roth, I would say the Roth for assets with limited current tax benefits, and then non-Roth for assets with strong current tax write-offs. That's what I would think about that. Okay, do we have any other questions here before we hop off? And again, if we didn't get to your questions, shoot us an email, preston@legacyinvestingshow.com, and we will get to your question. If we are not comfortable asking your question in here, or if we didn't get to it, just shoot us an email. So yeah, if there's any last minute questions, if not, just a reminder, we do have the session for day 3. So make sure you show up to day 3, whether you booked a call with my team or not. We have a ton of awesome content that we're going to be going over tomorrow. So make sure you show up for that. Going to be starting at 10 a.m. Eastern Standard Time. And then if you haven't booked a call, or if you join late, or you have no idea what we're talking about, managemoney101.com. It's just a way to book a call with my team. See if any of the programs here listed on the screen can be a good fit for you. No pressure. It's just there to see if we can help you out. If not, I'll just book a call just to make sure that we can see the different benefits that we can give you. Okay. And then if the call, so it's once you book a call, calendar might look like this. So it's going to show, come to this right here. So obviously all the calls have been booked for January here. Just click this little arrow, and then it's going to give you some time slots for the days that are available right now. And if none of these time slots work for you, just shoot us an email, preston@legacyinvestingshow.com, and we'll make sure that we try to find a time that works for you guys. Okay. All right, guys. Well, hope that was helpful. Hope you guys learned a lot. And then again, for the recordings, we'll likely send those out to the VIP members on Monday. Once my editor gets everything, gets all the recordings and edits all those for you. And then for the workbooks, anything like that, check your email. If you didn't get those, just shoot us an email, preston@legacyinvestingshow.com, and we'll help you out. Okay. All right, guys. Hope you guys learned a lot here today. Had a blast. Final day tomorrow. Get some rest. Bright and early. We'll see you guys 10 a.m. Eastern Standard Time, and we'll wrap up things up on day 3. Okay. Super excited for that. Thanks for the time, guys. We'll talk to you guys soon. See you.